Imagine having $100 ready to invest, but every time you prepare to buy, the same questions appear. Is the market too expensive? Will prices fall tomorrow? Should you wait for a better opportunity? Weeks become months. And while you are still waiting for the perfect moment, your money remains on the sidelines. But what if you stopped trying to predict the market? What if you invested the same amount on the same schedule, whether prices were rising, falling, or moving sideways? That simple strategy is called dollar cost averaging, and it changes the question from when should I invest to question how consistently can I invest? Dollar cost averaging means investing a fixed amount of money at regular intervals, regardless of what the market is doing. It could be $50 every week, $200 every month, or another amount that fits your financial plan. The amount and schedule remain consistent. The market price does not. Imagine that you decide to invest $100 into a broad market ETF. You do not check whether the market is at a record high. You do not wait for experts to agree, and you do not cancel the investment. Because of a frightening headline, the purchase happens automatically, month after month. Because you always invest the same dollar amount, the number of shares. You receive changes with the price. When the investment is expensive, your money buys fewer shares. When the price falls, that same amount buys more shares. You are not predicting the decline. You are simply continuing to invest through it. Here is a simplified example. In the first month, the price is $10. So $100 buys 10 shares. In the second month, the price falls to $5, so you buy 20 shares. In the third month, the price returns to $10, and you buy another 10. You invested $300 and accumulated 40 shares. Your average cost was $7.50 per share. The alternative is often an attempt to time the market. Buy before prices rise, wait before prices fall, sell before the next crash. It sounds logical, but markets react to information almost instantly, and the future rarely arrives exactly as investors expect. Dollar cost averaging does not predict the next move. It removes the need to predict it. Markets do not only move prices, they also move emotions. Rising markets can create fear of missing out. Falling markets can create panic. Both emotions can lead to impulsive decisions. A predetermined investment schedule creates distance between the investor and the daily noise. The decision has already been made. For a long-term investor, falling prices are uncomfortable. But during the accumulation phase, lower prices also mean that each new contribution buys more shares. That does not make a market decline harmless. The portfolio can still lose value, but regular investing turns changing prices into part of the process instead. For many people, dollar cost averaging happens naturally. They do not begin with a large amount of cash. They invest part of each paycheck as it arrives. The contribution enters the market every week or every month. This creates a simple connection. Earn, save, invest, repeat. Dollar cost averaging is not automatically the best choice in every situation. Imagine that you already have $10,000 available. You could invest everything immediately or gradually invest it over several months. If the market rises during that period, investing immediately may produce a better result because more of the money was invested earlier. Dollar cost averaging controls when and how often you invest. It does not transform a bad investment into a good one. Regularly buying a declining, unprofitable company can still produce serious losses. The strategy is commonly associated with diversified, long-term investments because the quality, cost, and risk of the underlying asset still matter. Consistency cannot replace research. The simplest DCA system is usually the one that requires the fewest repeated decisions. Choose an amount. Choose a schedule. Select the investment. Then automate the contribution when the platform allows it. After that, The most important part is not checking the portfolio every hour. It is making sure the plan remains affordable and connected to a long-term goal. Dollar cost averaging manages timing risk. It does not eliminate investment risk. If the entire market declines, the value of the portfolio can decline with it. Transaction fees can also matter when small amounts are invested frequently. And if the investment is concentrated, expensive, or poorly designed, a regular schedule will not solve those problems. DCA is a process. It is not protection against every possible loss. The most common DCA mistake is following the plan only while markets feel comfortable. Some investors stop buying after prices fall and return only after prices recover. Others choose an amount that is too large to maintain. A sustainable plan should survive ordinary market volatility without damaging the investors. Emergency savings or short-term finances. Remember 3 things. First, dollar cost averaging means investing the same amount at regular intervals. Second, it helps remove emotion and the pressure of finding the perfect entry point. Third, it cannot guarantee returns, eliminate market risk, or rescue a poor investment. Dollar cost averaging is not exciting. It does not promise the perfect purchase, and it will never remove uncertainty from investing. But for people building wealth gradually, it can create something more useful than a prediction. Repeatable process, invest regularly. Remain diversified. Keep costs under control. And give the strategy enough time to work. In the next episode, we will examine another force that quietly shapes every long-term portfolio: compound interest.